Okay, alrighty. Well, hey, we are hitting 11 on the dot. So thank you all so much for attending our webinar. I know that we've only got one more this year, actually, believe it or not. I can't believe how quickly this year has flown by. But anyway, my name is Lucas Amel, and today we are going to be talking about predictable retirement income. Okay, this is a big, big topic. I see it as a lot working as a financial planner. So that's why we wanted to put this presentation together for everyone over at Advocate. So quick little factoids about me, and I'll be quick because I know you guys want to talk about the fun stuff, right? All right, so who am I? My name is Lucas Amel. As I said, I have been doing these webinars within the hospital systems in Wisconsin as well as Illinois for the past couple of years here. And sorry, I got distracted. I work as a fully licensed fiduciary financial planner. I'm servicing clients kind of all over the country at this point. I've been doing it for about 8 years. I've got background in tax preparation, investment management, operations management. I've managed hundreds of millions of dollars. Like I've kind of seen a lot of things happen, right? So that's always what I tell people is, like I've seen the benefits of proactive financial planning, which is why I'm a big advocate for it, which is why I'm doing these presentations for the advocate system. The HR people let me do them. So that's kind of the big thing is just like really, I've seen the benefits of proactive planning, and unfortunately, I've seen what it looks like to not have a proactive plan in place. So we're just trying to get as much good information out there as we can, right? Um, Enough about who I am. Who I am not. I am not an attorney. I am not your CPA. So, nothing in this presentation is meant to be treated as specific personalized advice for both a tax perspective and a legal perspective. Okay, so what is financial well-being? This has been an ongoing series that we've been doing for folks. At this point, we've done, I think this is like the 29th one that we've done, and all of them are recorded. I'll work to create a menu that people can access previous recordings because I feel like I have at least a couple people every week ask me. We have not done that. It's something I'll make sure my marketing girl does. But this has been an ongoing series where we've kind of focused on these four main pillars of financial wellness, right? So the first pillar, having control over our day-to-day or our month-to-month finances. I see this all the time with new people that I'm meeting as well as existing clients where it's like, hey, what do you make? And they'll be like, I don't know. So ultimately, one of the first cornerstones of being financially well is having a budget, and understanding your cash flow. Cash flow is king, both in just living life and retirement planning. Cash flow is the most important thing. So that's why, today's topic, we're going to be covering income in retirement. That's kind of where it ties together is everybody's used to earning a paycheck, getting a paycheck, and going about their life. Well, what happens when that paycheck stops, right? That's what we're going to be talking about today is turning our assets into income. So first pillar there, having a budget. Second pillar, having the capacity to absorb financial shock. Okay, so what does that mean? Well, similar to the budgeting thing, a common issue that I see with a lot of people at all age levels and all income demographics is not having some kind of emergency fund or liquid place that you're keeping money that you can tap into if you need something outside of your budget. So whatever, furnace finally kicks the bucket, you've got to pay $15,000 all of a sudden, or whatever a new furnace costs now. I should know. I just bought one like 3 years ago. But all of a sudden you need to pay $15,000. Well, where are you accessing that $15,000 from? Do you have an emergency fund in a bank or a certificate of deposit? Do you have to pull from your 401k? And if so, are you able to? What kind of ramifications are that? Is there a tax impact? There's a lot to think about when we're looking at different sources. So that's the second pillar here, is having some kind of an emergency fund or contingency plan set aside for when life takes you outside of your budget. Third pillar here, being on track to meet financial goals. Of course, the first step to being on track to meeting your financial goals is having financial goals, right? So, realistically, we do a whole webinar on this as well, on the financial goal setting, financial goal planning. So if you need help with that, just shoot me an email after, and we can kind of help you out there. But realistically, having goals, so like, when do you want to retire? What does that look like? How much money will you be making? Are you sending your kids to school? Or when do you want to pay your student loans down? Like, having goals is hugely important to actually accomplishing them. It's just an idea until you put it into writing. So they're hugely important. Fourth, and this is kind of like an all-encompassing thing, is having the financial freedom to make that's going to allow you to make the choices that you want to make to live the life that you want to live. That's ultimately kind of tying the three together, right? So having a budget, having a contingency plan for when stuff goes off course, and then having a course that you're plotting, that's really going to allow you to enjoy your life a lot better, and give you a lot more peace of mind as you're going forward navigating the financial landscape. Okay, so enough about all that. Why don't we jump into kind of the meat and potatoes here? So today we're going to talk about a couple different things, right? First, we're going to talk just in general terms about two broad financial phrases that most people who are planning for retirement are going to need to address, right? Accumulation and distribution. Okay. Then we're going to discuss annuities. So, annuities, I feel I've heard a lot of mixed feelings about them. They've been around for a long time. Technically all pensions are annuities. So we're going to help people on this call understand a little bit more about what annuities are, what they do, why they might be good, why they might not be. Okay. And, then just go over important considerations with both, the annuity side of things as well as the accumulation and distribution phase. Okay. So accumulation and distribution. So this is a lot. I ask this question to a lot of people when I'm first meeting with them, is, like, hey, when you're climbing the mountain, what's the goal? And, a lot of people, of course, they're always saying, well, to get to the top of the mountain, of course, like that makes sense, right? So, retirement's kind of like that. You're climbing and climbing, you're grinding and earning that paycheck throughout your whole working career. And then you finally retire. You finally get to the top of the mountain, right? Woo. Well, okay, now what? You've got to get back down, right? So this is the part that I feel like this requires the most planning. And realistically, you can start planning from retirement from the first day that you start working, right? Based on how you're saving and, of course, where you're saving, both in how you're investing and how it's being taxed later. But this is hugely important. So, there's two main financial phases that most of us are going to address during our lifetime. Okay. The accumulation phase, or our career, our working phase where we're saving, and our distribution phase, right? Where we're spending down the assets that we've accumulated during, our years. So during your working years, you of course get to accumulate assets, you're building up sources of income, and you're going to be using these things during retirement, right? On your way down the mountain. In retirement, you're transitioning from accumulating, building up this nest egg, to distribution, when you actually have to start using the assets that you've accumulated to generate income. So this is like what I was saying, replacing your paycheck in the future. Okay. So for many people, it can be very different to kind of have this mindset shift of saving forever, right? And now you're spending mindset's very different. And sometimes people get very scared. A lot of my clients who are in retirement, they probably have only hired me to give them permission to spend their own money, right? So a lot of questions that I hear a lot of the time is, how much can I withdraw from my savings? How much is too much? Am I going to run out of money? Am I not spending enough? And believe it, a lot of people do fit into that category just because they're paralyzed by fear of not running out of money. Like a lot of surveys that are out there for retirees or people nearing retirement say that their number one biggest concern in life, just in general, is running out of money. It's not even dying anymore. It's running out of money. People are afraid to run out because, as a lot of people know, life gets very expensive as you get older, especially if you need to go into like a nursing home or stuff like that. And, a lot of people have helped their parents go through it. So it's a very realistic concern. So let's kind of shift gears here and talk a little more in depth about the accumulation distribution stuff. So with the accumulation phase, there's a couple different vehicles that we're using, right? So as you know, there's a lot of different ways to accumulate money during the working years, and you probably already have some of these things. So, there's 401k plans, IRAs, savings accounts, mutual funds, certificates of deposits. Of course, there's annuities. Each of these financial vehicles has their own unique characteristics, and it's going to help you save for retirement. Okay. So we're going to kind of scope in on the annuity one today just to help people understand what these are, because I would say that's the least understood financial vehicle that exists. And they're very complicated, candidly. So, another word on the distribution phase, since we talked accumulation, the annuities come into play in the distribution phase. Okay. So most savings vehicles that are out there, they're going to be finite, meaning, hey, you've got $100 in this account. When you have $0 in this account has $0 and it means nothing to you. Okay. Annuities, they're unique, and this is where they come into play with that, addressing the number one concern of individuals of running out of money. They offer guaranteed lifetime income. Okay, so that's the biggest draw to them. So they can be used as a savings vehicle during accumulation, but they're also used as a source of retirement income during distribution. Okay, so that's kind of like what this is showing here. And I'll talk more about that in a second. But while most savings vehicles are finite and you have a set amount of money in it, that's going to be depleted over time. Okay, so annuities they're unique because they're giving you that guaranteed lifetime income. So it's similar to like a social security benefit or a pension benefit. So like I said in the beginning of the call, your pensions that you're getting through Advocate or through Children's are annuities. If you look at the statement, it says company annuity. So there's pensions which are offered by a company, and then there's actual annuities, which people typically are buying on their own. So not all of them are designed to be paychecks, but that's kind of what we're talking about today. So, an annuity, it's an insurance product, and it's designed to pay out a stream of income for life or for a specific period of time. So this is to kind of help you understand what we mean here. Here's slightly different take on the accumulation and distribution graphic that we were looking at before. So in the previous graphic, we were seeing that, there was an arrow up during the accumulation phase, and then it peaked at retirement. Then at retirement, we started distribution, we kind of going down, like it was more of a mountain going back to here, right? So we're going up, we're going down, right? This one's just showing it as flat. But an annuity, that's kind of why, is because the annuity is guaranteeing that, hey, we're going to just pay out this number forever. You're not going to really need to worry about, is it going to get to a point where I'm spending down where my regular paycheck's going to stop? That's where the annuities kind of come into play. And typically, I don't see people putting all their money into annuity. I don't think it's legal that you even do that. But let's kind of talk about the basics, how these work, what this is, just so you can kind of get a better, understanding here. So did you know that annuities are only offered by insurance companies? So that's why pensions have kind of become antiquated. A lot of private companies used to offer pensions to all of their employees However, they found that it got too complicated. There's a lot of administration. They were making promises that they couldn't keep. That was the biggest one, I think, is because, like, realistically, with all this, you need teams of actuaries that are running numbers, looking at, hey, what's the mortality age of people, and like doing all these averages and calculations and spreading that risk amongst millions of policy owners. Where, when we were in the traditional days of pensions, a small corporation would set up a pension plan for their 50 employees and be like, okay, well, we're going to pay you $3,000 for the rest of your life. And then they realize how much that dollar amount on a month-to-month basis actually came out to be, and those companies started going bankrupt. So that's why most companies don't offer pensions anymore. Even the one that's within the advocate healthcare system is discontinued. So, say you've worked there for 20, 30 years, you'll have a pension, but it's been frozen for like a decade, right? And that's the reason why, is because Advocate realized, they're like, holy crap, we have tens of thousands of employees. We cannot promise to pay each one of these people until the day that they die. We can't keep track of that anymore. So that's why pensions are kind of antiquated, is because of the natures of the guarantees. These smaller companies can no longer keep up with it. So let's kind of talk about what they are here. So let's just assume you decide to purchase an annuity from a company. Depending on the contract provisions, you can make a lump sum purchase, or you can buy it over time in multiple. I see most people do it as a lump sum, where you take a chunk from your 401k, you pop it with an insurance company and say, hey, I want a paycheck forever. What's the rate? That's kind of how they work. So in exchange, you give them that dollar amount, the insurance company is going to provide certain guarantees that are going to be detailed in the contract. Okay. So for example, some annuities are guaranteeing a certain interest rate for a certain amount of time. This is where we're kind of breaking it up, where it's not just fixed, like the income. Basically, the two main things that annuities are going to guarantee is principal or income. So say you put $100,000 in, and you're in a fixed annuity, and the company's promising you, hey, we'll pay you 4% every year on your $100,000. No matter what happens in the stock market, that hundred's never going to go backwards, right? It's only going to get credit the 4% every year. It will never make more than that, but it will never make less than that. It'll never go down, etc. The other says, oh, that's guaranteeing principal, right? It's putting a floor on your money. No matter what happens in the market, it's kind of exempt because it's now an insurance product. It's not like a mutual fund or anything. The other side is the guarantee of income, which is kind of more the focus of today's thing, where, hey, you give them a lump sum payment and they say, hey, great, at this age, we're going to pay you this, and we're going to pay it forever, no matter how long you live. That's kind of how most of them work. So when you're ready to kind of start receiving that income and annuitize the contract, they're going to make annuity payments to you based on the elections that you've made in the provisions of these contracts. So the income that you're getting that's generated from the annuity can be guaranteed for life. It can be guaranteed for a specific period of time. I've seen them guaranteed for two people's lives. So like a spouse and a spouse are married. One dies, but it keeps paying until the other one dies. I've seen it set up where it's other way around, where, hey, it's on one of them. When one of them dies, the payment drops off. People might say, well, why would someone do that? All of these things are unique, right? So like every decision that you make when it comes to choosing how an annuity is structured, choosing when your pension starts, choosing how to claim Social Security, they all should be a very unique decision. Like, it's not something that you Google online, like when to take Social Security. It's going to be dependent on your family's situation. Is there an age gap between spouses? Is one of the people way healthier or not so healthy? There's a lot of things that go into it. And how you choose to structure these things determines the benefits that they're going to be promising you as well. Okay. So of course, if I took out an annuity on myself, say, like I'm married, I take it out on myself only, my payout's going to be higher, but when I pass away, my spouse gets nothing. If, of course, I take the pension or the annuity with me and my spouse as joint owners on it, the payout's going to be lower. But then if something happens to me before my spouse, they would continue to receive those payments, right? So there's a lot to these, right? So there's kind of two main types of income-oriented annuities, right? So there's immediate, which basically they're going to start paying within a year of you making the purchase, or there's deferred, okay, where maybe there's a year or more until the payments start. I see a lot of both, truthfully. And I mean, all of this changes with what's happening in the world as well. Because we were at I can't say like historically high, because we've seen way, way, way higher rates in the past, but like the guarantees that these are offering are going to largely be dependent on the interest rate and what's happening with the interest rate. So recently we were in a kind of a spiked interest rate environment. Okay. And I saw a lot of people putting money into these immediate annuities because insurance companies were promising people that were retiring like 7, 8, 9% distribution on their money. And typically when you're looking at finance and the realm of retirement income planning, when you're looking at like your 401k or any brokerage accounts that you might have, typically they say that you should only be tapping into 3 to 4% of that money. So I'll say that again, and just like let it settle in for a second. Okay. Say you have $1 million. Okay. Based on retirement science, what they say is a safe distribution number of, 3.5, 4%. They've found that number to be like statistically the percentage that you should be tapping into your 401k to not run out of money. Like no matter what happens in the stock market, they say if you take about 3 to 4%, pretty much any market scenario, and you live an average life expectancy, you're not going to run out. Okay. So what these annuities do is they allow you, so say, like with that $100,000, say we're doing the upper threshold, right? Or the million, sorry. And we're trying to access that 4%. Well, that's only 40 grand a year. A lot of people, most people that I know that have accumulated $1 million, they make more than 40 grand a year, right? So that a lot of people get shocked when they hear that number, but that's where these annuities come into play, is because they're giving you a guaranteed source of income. So, say, going back to my example before, saying, hey, okay, well, if I've got this $1 million and I can do 4%, that's 40 grand, right? Well, what if I chunked out $300,000, put that into an immediate annuity, and it was paying out 8, 9% from that value? That significantly increases your retirement income. So that's where these come into play. Sorry, I kind of went on a tangent, but that's what this whole thing is about anyway. It's kind of just me talking. So, but that can be done with immediate as well as deferred. Deferred annuities typically have other provisions in the contract where they're offering you some kind of step ups and stuff like that, where they make promises on how it grows in the period that you're not drawing income from it. So there's a lot to say about both of these, truthfully. So we tried to just make it basic. If you have annuities and you don't know what they are, I am happy. Me and my business partner are nationally renowned specialists when it comes to annuities. So if you want us to take a look at a contract that you bought years ago and you don't know what it is, I'm more than happy to. With a lot of these deferred ones that I see out in the marketplace, a lot of people are paying absurdly high fees for them and for benefits that they might not ever even use. So it's really important to know what you have. Like I literally have a meeting right after this where I'm reviewing an annuity contract for somebody, and they're paying 2.5% on like $400,000. And it's for a lady in a nursing home. She's not going to ever turn income on or anything. Like she forgot that that's how it worked. But that's part of why personal finance is so interesting is like, it's really important that you review everything that you have at least once a year to be like, hey, does this still like meet my needs? What is this? What am I paying for this? Because that's one of the things why, like if you've heard annuities, typically it's in a negative sense. Okay. And that's because back in the day when they were first getting, rolled out to the public, they had really high surrender penalties, really high fees. Your money gets stuck in them forever somehow. Like there's a lot of negative to it, but the industry's come a very long way. A lot of annuities now are low to no fee. And if you're paying a fee, you better be getting a benefit for it. So I did just want to kind of throw that in there. So let me zoom in real quick here on the immediate annuity, just so we can kind of talk to it. So we just kind of mentioned that it begins to pay out a stream of income within the first year of you buying it in exchange for a lump sum payment. So, and it can be an option for someone who's nearing or in retirement who wants, their assets to turn into a direct stream of income rather than a manual pull. So there's a lot of numbers of reasons why you might want to do this. So first of all, create a predictable source of guaranteed retirement income that you cannot outlive. That's the number one reason. And especially that latter part, the part that where it's saying you cannot outlive this. So what's nice is that, going back to my example of the $100, right? So say with that $100 account, you're retired and it's not an annuity, and you spend down that $100 at a rate of whatever, say you're spending $5 a year, right? So now that whole account's gone. And guess what? You're still alive. You need that $5. Well, your account zero, they're not going to pay. So say we had that same 100,000 in an annuity that was guaranteeing an 8% distribution. Okay. Well, what's happening with that is that they're going to pay that $8 per year forever, as long as you're still alive. So even when the 100 that you initially put into the account goes to zero, they're going to keep paying that $8 because that's the promise that they made to you. Okay. And so this is what it's meant to do, is just create that stream, create that paycheck that you can have the confidence on, that you can count on, no matter what happens in the stock market, no matter what happens in your life, in your world. As long as you're still alive and kicking, they're going to keep paying for that. So another way that people use these is kind of creating an income bridge between 2 points in time. So say, for example, you're retiring early, but you don't want to start Social Security until here. You can have an annuity pay out during that period of time to bridge the gap to get you to Social Security more comfortably, or to delay Social Security to get better benefits. So there's a lot of ways that we use annuities in planning, and you don't always want to just scope in on just the annuity. You want to look at, okay, well, how is this going to work in respect to my whole situation? How is this going to work in respect to my whole financial plan? So is an immediate annuity right for everybody? Absolutely not. But is it good for some people? Absolutely. I'm surprised there's not a deferred one. That's probably because they're so complicated. Oh no, I'm still talking about it. So first and foremost, an immediate annuity may be good for you if you have available assets that you can use as a lump sum, and you don't need that lump sum amount for anything else, right? You want to create a paycheck. You don't need to put a big down payment on a house or something, because that's the biggest drawback of annuities, is you lose the ability for full liquidity of that money, right? So for example, let's use the $100,000, right? Say you've got $100,000 and you want to put it into an annuity that is going to pay you whatever every month for the rest of your life. Great. Say you do that and it starts your paychecks, and then you're like, oh, wait, actually, I want to buy a house down in Arizona. I need to pull $20,000 from my annuity, that 100,000 that you put into it. A lot of times you can't do that. Otherwise, it significantly disrupts the promises that they're giving you if it was specifically for income. So it's one thing to keep in mind, right? Like if we're doing these immediate annuities and you're turning it into a paycheck, you're losing your liquidity. You're not going to have that $100,000 that if you needed to pull 20 grand from it for whatever reason, you can do that. So, that's the biggest cons, right? So it's good fit if you want income stream, you want the guarantees that you're not going to outlive, or you need to bridge some kind of gap. You need to supplement some kind of retirement income, like we have Social Security. Maybe you have a pension. If we need more on top of that, where you feel like, hey, this gives me the peace of mind to be retired so that I can feel comfortable spending my money, that's where it comes. But like I said, the biggest thing with these is the liquidity, your access to your money above and beyond what the promise is. So that's my biggest cautionary type thing with it. So that's the immediate annuities. Let's kind of talk a little bit more about the deferred. And with these, there's kind of three stages, right? There's buying it, there's deferring it, and then there's the distribution. Okay. So when annuitized, deferred income annuities begin making annuity payments at or at least 1 year after when you purchase them. So there's a lot of different kinds of these. Like I was saying, there's variable, there's fixed, there's this, there's that, there's all these bells and whistles and riders that agents will try to put on to them. Like some of them make sense. Just really, really, really know what you have or what you're buying. I would strongly caution that. I've seen people paying fees as high as 3.75% on some of these things. Which, if it's giving you the peace of mind for retirement that you feel comfortable with, that's totally fine. But, like I said, there's been a lot of fee compression in this space. So people that have annuity contracts that are like 10, 15, 20 years old usually can be replaced with something drastically better for cheaper nowadays. But this is how the deferred works. It's still similar to the other one, the immediate, but there's just this deferral period. And like I was saying, depending on what kind of deferred income annuity that you purchase, the deferral period is going to behave differently. Some of them have investment sub accounts that we can be in. Some of them are just going to guarantee that your principal grows by 6% every year. Some, there's a lot of different things. There's a lot of different ways to do it. They're all unique. So that's why I was saying this is just to kind of general give you an idea. But what a lot of people will do is buy one prior to, I would say the most common age that I see people turn annuities on is 65. Because most of them kind of give you brackets on, hey, we'll pay out this percent if you're between this age, and this percent if you're between this age, and so on and so forth. Most people, I feel, wait till 65 because that's one of the big bumps, and that's probably the most common age to retire. But during that deferral period, after you purchase it and when you distribute, the money still grows. And how it grows is determined by the contract that you get it set up on. So here's just kind of side by sides, right? Now that we've kind of reviewed the primary differences between immediate as well as deferred, let's look at kind of the differences between them. So deferred income annuities typically is going to offer you a declared fixed interest rate, which may be guaranteed for a specific period of time, right? So the money in the fixed contract being held in their general account, your principal's protected, but you get it back when you make the withdrawals. So that's one kind. And then there's the variable side. So with the variable side, this is kind of like what I was talking about. It can be like invested in the stock market and something. So the accumulation of the assets, it's going to be determined by what like the underlying performance of the funds are. Neither of these is the best one, like depending on when you buy it, I guess that makes the difference, but nobody knows what's going to be happening in the stock market. Over the past 10, 15 years, variable annuities have done very, very, very well because the stock market's done very, very, very well. In years, like we've had historically entire decades where there was no growth. The fixed stuff works really well. And what a lot of people do is blend these. I see that very often as well. So who are these things appropriate for? So like these fixed annuities, they're more predictable. They might be a little bit more appropriate for investors that seek to conserve principal, right? So protecting what they actually have, being very conservative, getting a guaranteed rate of return. They're also good for people that are aggressive, but they want to add a conservative element to their overall allocation, right? So maybe you're all stocks and you want to take a chunk of your money and put 10% into something that these are basically certificates of deposit, but they go for more years, right? So what's nice about that is like what we're seeing a big inflow of right now is, we're on a descending interest rate curve. Okay, so for a while here at banks, you were able to get like 6% in a certificate of deposit. Well, now the Federal Reserve is declaring, hey, interest rates are going down. They've already cut them once. They said that they were going to cut them 2 more times this year. So what a lot of people are doing is putting their money in a fixed deferred annuity that has no tie to income, but they're saying, hey, I can park my money here for 5 years, and each of those 5 years, it's going to pay me whatever the declared rate is right now. That seems like a no-brainer because I know that the interest rates are going down at the bank, and you typically, I think the longest bank CD you can own is about 18 months. So what the smart people are saying right now is like, hey, 18 months from now, if I know interest rates are going down, why would I not lock in a higher rate that's guaranteed for 3, 4, 5 years? So that's where I kind of seen those come into play a lot. The variable annuities, going back to who it's appropriate for, is more aggressive investors who they want the elements of guarantees that annuity companies offer, but at the same time, they want to be in the market. They want to participate in market growth and, potentially downside, but they want to take the risks in the market while still getting some kind of a wrapper where there's some kind of guarantee associated with it, right? All right, so there's a lot of different options for the payouts. Hold on one second. Let me get some water. Okay, so we've been talking a lot about like the ability to generate income. So now let's talk a little bit more about like how long that income stream might last. Typically, these are the three main kind of ways to getting an annuity structured. Okay, so life only, you're going to receive a guaranteed stream of income for as long as you or your spouse, if your spouse is listed as a joint annuitant on the contract, is set up. So just to be clear too, I should have said this in the beginning. These are the exact options that pension plans have as well. Okay, so like everybody here that has like the advocate pension, these are going to be the same options that you're going to be listed when you fill out your pension clarification forms. Okay, so then there's this life with period certain. So what that means is that payments are going to be made for the lifetime of the person that's listed as the owner. Okay, but the payments are still guaranteed for a minimum period of time anyway. So, like for example, say I started my pension and a year into having the pension, I passed away, right? If I had it on my life only, my spouse is going to get nothing. Okay. However, with this life with period certain, what they're going to say is, oh, okay, well, if I checked to that box and I said, hey, I want this to pay out no matter what for 10 years. Okay. And I pass away on year 1. Well, they'll still pay out for 9 more years and then the payments stop. Now, remember, with all these, you're taking trade-offs. Okay. So, you're paying for some kind of guarantee. So over here, life only, if I do life only on just myself as a single individual male, my payout's going to be the highest, right? If I put my spouse on it and now there's 2 people and she's female and her life expectancy is longer and they're going to pay me out less. Okay. And so these period certain things, these are basically the same. I don't know why we even put both of them on here, but basically like these period certains are just saying like, hey, no matter what happens to you as the pension owner, we'll still guarantee that we're going to pay out X period of time, even if you're still passed away. Okay. So this is an important consideration with it because I think a lot of people have questions on it. So like I said, I'm not a CPA or anything like that. I actually used to do taxes for 3 years, but this is better for me. So let's talk about taxes, right? So money in a deferred or fixed variable annuity, it's going to be accumulating for you on a tax deferred basis. Okay. So that means that you're not going to be paying any kind of income taxes on earnings in your contract until they are withdrawn as income. Okay. So that means more of your money remains available to benefit from the growth until you actually turn it into income. So that's one of the biggest benefits with these, is that they automatically turn like non-qualified money into almost retirement money, like qualified. It puts a tax wrapper on it. Okay. So say you had $100,000 sitting in your bank account and you put it into an annuity and it starts growing at 6% a year. Well, that 6% is not taxed. Whereas say you put that $100,000 into a brokerage account, right? And you invested in the S&P 500 or something like that, and it gets that same 6%. Well, guess what? That 6% is subject to interest tax, dividend tax, capital gains tax, etc. Whereas an annuity, it contains all that until you start processing distributions. That's when you tax. So it gives you a little bit more control over the timing on when you might pay taxes based on how the distributions are set up. So distributions from tax deferred annuities are subject to ordinary income tax. And if you're starting to collect them prior to 59 and a half, there could be a penalty. Because like I said, what the annuities are doing is basically turning money into a retirement vehicle for you. Okay. So it's not like your 401k has these same benefits and these same provisions where if you try to access it earlier than 59 and a half, they're going to penalize you, et cetera, et cetera. That's why a lot of people are drawn to the annuities, is because they don't want to have these big capital gains eating their returns over years, potentially even decades. So it's also important to note that the tax deferral is automatically provided in IRAs. So like if you move your 401k money into an annuity, well, you were already in that tax preferred vehicle. So it's not like an additional benefit. They like require me to tell everybody that. But yeah, the tax benefits are really there for people with non-qualified money that don't want to pay a bunch of like capital gains on a year to year. Okay. So other important considerations, I've already hit on this a couple of times, but I would say this is the biggest turnoff when it comes to annuities, both from your perspective as a consumer and my perspective as an advisor, is the expenses. Okay. So the first thing, this is where they get you with annuities, is these hidden fees, right? So surrender charges, this is the first one. So basically when you enter into an annuity, right, they tell you how long you are going to be invested in that annuity minimum. Okay. So what they'll do is they'll set up what's called a surrender schedule and basically be like, hey, if your money's parked here, you got to keep it here for 7 years. And if you want access to it before that 7 years, we're going to charge you a fee. Right. So that's where they get bad rap, is where people got into them. They didn't understand the surrender charges. They need money. They don't have liquidity elsewhere. They need to tap into their annuity. They pay a surrender charge and an early distribution penalty and taxes. And it gets really messy. So that's why it's important that you know what these things are before you get into them. And they're pushed very heavily in the financial service world because candidly, the commissions are pretty big. I'm seeing people make 6 to 7% as a commission on these products when, maybe the client didn't need it. Okay. Rider charges, right? So this was another thing that I talked about, is with annuities, they've got a lot of different like bells and whistles that you can put onto them. Okay. So there can be a guaranteed death benefit thing or a guaranteed income enhancement thing. And like, there's so many different ones that are out there. I'm not saying that they're bad, but what I would say is be careful if you're going to buy one, that you know what you're buying. And if you already have one, definitely review it, or let me review the riders that you have, because I mean, these things are what makes the costs just start adding up and up and up. Like I'm seeing that, like I said, I've seen ones that cost upwards of 3.5, 3.75% because of riders. Investment management fees. So not only is there fees to get out of the contract, fees to own the contract, but a lot of these variable annuities that have sub accounts, okay, the mutual funds that they're in or that you can pick from also have fees. Okay. So that's another thing to be aware of when you're looking at these or prospective purchases for fees. Like there are no fee variable annuities. We use them all the time. But some of these funds that are out there, they charge another 1% or something like that. And then the mortality and expense fees, this is a basic contract fee to like maintain the contract. So these are basically just another fee that kind of exists to offset the management costs and stuff like that. Contract management fees, same thing. So like there's costs to get in it, costs to own it, costs to invest with it, costs to get out of it. A lot of people might say, well, why would I do this? Well, costs are only an issue if there's some kind of absence of value. Okay. So if, your annuity might cost you 2.5%, but it does everything you need it to do within your plan. And that's just what it costs. As long as it's doing what it's supposed to, there's not really a big thing to complain about. But to wrap this up, and if you take one thing away from this whole presentation, I would say if you're gonna buy an annuity or if you own an annuity, you better really understand what you have, what it's promising, and what you're paying for that promise. That was the most beneficial part of the whole presentation. Just re-listen to that 10-second clip of me saying that. All right, so let's look at an example here. This is like one of the last slides too, so we'll get you guys rolling here. This is one of the biggest things that comes into play with annuity purchases is inflation. So let's look at a hypothetical example. Investor who purchased an immediate annuity back at age 55. Okay, so way it works, the annuity is going to begin paying a guaranteed income stream of $1,000 per month. That's going to continue for the rest of their life. Sounds good, right? Okay, now let's assume that the rate of inflation remains 2% annually for the next 30 years. Is that accurate? I don't know. I'm hearing a lot of people say that now it looks like 6. So we'll see. But in 10 years, that $1,000 payment that they were getting or they were using, all of a sudden purchases significantly less, right? So that $1,000 in today's dollars worth is now worth $800 or $817 worth of goods and services. Fast forward 10 more years, so another decade. Well, now that $1,000 is only buying $670 worth of goods and services. Fast forward 30 years, it's almost half. So that $1,000 a month that you were promised, yes, it still is $1,000 a month, but the cost of the dollar, as I'm sure all of us have seen over the course of our lifetime, it changes, right? And it's usually never changing for the better. It's usually becoming less and less valuable because we love to print money in our country. So that's one thing to keep in mind too, is when you're like chasing these promises, what kind of promise is it actually doing? And this isn't an anti-annuity presentation, just to be clear. It's a factual presentation just so people can know what these are, why it's important to know what you're getting. Because sometimes that sounds good, $1,000 a month, boom, I'm set. But if you're not thinking about inflation when you're planning for your retirement, you are not planning for your retirement. Okay, so let's talk about this a little more. So you may benefit from an annuity if you are, here's 4 little bullets, right? Like interested in having a predictable income stream you can't outlive, are looking for some kind of tax deferral or way to grow and pay taxes when you're in a lower tax bracket later. There's a lot of tax planning with annuities. You've already maxed out your other retirement, so your 401k, your IRA, and you're looking for more tax preferred vehicles to save and invest through. And, are you able to put away money and not touch it? That's the biggest thing with the annuities is like, it changes your access to the money. And I think that's the biggest takeaway that people need to have. So let's just kind of recap. I know this was very general, but it was meant to be. Same with, I always get that with the Social Security one too. So understand what kind of annuities are out there, right? So we've got the immediate, we've got the deferred. Understand that those can be fixed, those can be variable. And the biggest considerations to make with that is, how is this going to impact my taxes? How much what are the expenses associated with it? What are the expenses on getting out of it? Those surrenders that we talked about. And, when I'm planning for this and planning my retirement income, how can inflation, interest rate, as well as the stock market impact how all these things work together? Okay. So yeah, this is basically just a slide saying, before you purchase an annuity, you should really think about these things. But I have to show it. All right, yeah, so here's all my contact info. I do make myself available for everybody that registers for the webinars for a quick consultation. If you want to chat, just do a check-in. If you want to talk retirement planning, if you have income annuities that you want me to review, or 401ks that you want me to review after the election, this is a service that's provided for everybody at no cost. So those are complimentary consultations, like kind of through HR. So, all right, well, I don't see any questions on here. And truthfully, this is kind of the presentation that's better, that questions are asked to me directly regardless. So thank you all so much for your time. Thanks for putting up with me and my sinus infection. I hope you all have a wonderful Thanksgiving and holidays to follow. And of course, thank you again for supporting our financial wellness series here. I hope all of you have a wonderful rest of your day and holiday. Be well, be safe, and take care. Bye now.